Welcome to The Explainer. Today we're putting a magnifying glass on a fascinating and honestly pretty misunderstood corner of the financial markets: high-yield agency mortgage real estate investment trusts, or MREITs. Specifically, we're zeroing in on ARMOUR Residential REIT. Now, if you've been out there hunting for yield, you've almost certainly crossed paths with these guys. But today, we're looking past those flashy headline numbers to understand exactly how this engine actually works. All right, let's jump right in.
Section 1. The high-yield allure. First off, we've got to address the elephant in the room. Why are income-focused investors consistently so drawn to this specific sector, and to ARMOUR in particular, right now? Well, it really just comes down to one magnetic number.
16.5%. Yeah, you heard that right. That is ARMOUR's current dividend yield, according to the recent Sure Dividend analysis. Look, in a market where traditional fixed income often yields just a fraction of that, a 16.5% payout is an absolute magnet for capital. It's an eye-popping number that immediately demands your attention.
But that brings us to the central question of our explainer today. Is a 16.5% yield a genuine goldmine for your portfolio, or is it a structural trap? To answer that, we can't just look at the payout in isolation. We have to open up the hood, see exactly how this yield is being manufactured, and figure out its true cost.
Section 2. Inside the MREIT engine. Let's actually pop that hood right now and break down the complex mechanics behind the company. How does an MREIT physically make its money?
ARMOUR essentially acts as a highly specialized financial intermediary. They're running a leveraged carry trade. In plain English, they buy mortgage-backed securities, specifically agency MBS backed by government-sponsored entities like Fannie Mae and Freddie Mac. So the underlying credit risk is incredibly low. But to buy these safe, relatively low-yielding assets, they fund themselves with short-term debt, primarily through repurchase agreements.
So, here's the core profit equation that drives the whole operation. Step 1, you take the asset yield from those government-backed mortgages. Step 2, you subtract your short-term funding cost. Step 3, you adjust for the net settlement from interest rate swaps they use to hedge the portfolio. That leaves you with a net spread. And usually it's a tiny spread, maybe 0.5% to 1.5%. So how on earth do you get a 16.5% dividend from a 1% spread? Leverage. ARMOUR typically applies between 6 to 10 times leverage to multiply that tiny spread into a double-digit return on equity.
And this brilliantly illustrates why they even use the REIT structure to begin with. A regular C-Corp doing this would pay a 21% federal tax rate on that income before shareholders ever saw a dime. The REIT structure acts as a massive tax shield, totally eliminating that corporate tax drag. But here is the crucial trade-off. To keep that shield, ARMOUR is legally required to distribute at least 90% of its taxable income to shareholders. Because of that, they really can't easily retain earnings to grow or protect their capital base.
Section 3. The distributable earnings illusion. Because of that 90% mandate we just talked about, investors obsess over how much cash the company is actually generating to pay those dividends. And this brings us to a metric you'll see everywhere, but one that can be highly deceptive.
Distributable earnings. It's a non-GAAP measure that intentionally strips out all the noisy, unrealized mark-to-market swings on their mortgage bonds and derivatives. It's designed to show the underlying cash-generating capacity of the portfolio. If you just want to check if this quarter's dividend is technically covered by cash flow, this is your starting point.
But here is the massive catch, and it really is a big one. Distributable earnings completely ignores the actual value of the assets sitting on the balance sheet. A company can post strong distributable earnings per share, making the dividend look perfectly safe, while its underlying net asset value per share is steadily declining due to widening spreads or inadequate hedging. It's an illusion of safety. You might be collecting income with one hand while quietly losing your capital with the other.
Section 4. The anchor. Book value. So, if distributable earnings only tells us half the story, where do we find the truth? We have to look at the absolute bedrock of the balance sheet.
You find it in book value. It's the true anchor of MRET valuation. This is simply total assets minus total liabilities divided by the number of shares. Because agency MBS are mark-to-market, book value reflects the actual, real-time fair value of the company's portfolio. It's exactly what the company is actually worth if it liquidated today.
When we put these two side by side, the contrast is pretty wild. Distributable earnings measures cash generated, completely ignoring asset value. Book value, on the other hand, measures the intrinsic value of those underlying assets. If an MREIT pays out a massive dividend, but its book value is steadily dropping over time, they aren't creating wealth. They're just returning your own capital back to you and calling it a dividend.
Section 5. Economic return tells all. To avoid falling into a yield trap, we absolutely need a metric that synthesizes both the income you receive and the capital you are trying to preserve. Enter total economic return. Honestly, this is the ultimate scorecard. The formula is beautifully simple. Take the dividends paid during a period, add the change in book value, and divide that by the beginning book value. This one formula gives you the complete, unvarnished picture of whether management is actually creating wealth for you or destroying it over time. And when we actually apply this to ARMOUR, the reality of that 16.5% yield becomes a whole lot clearer. Just look at this historical breakdown. Sure, in 2021, a solid 14.6% return. But look at 2020, negative 13.6%. Look at 2022, down over 30%. And looking at the projections for 2025, a staggering negative 33.9%. These numbers prove, without a doubt, that massive dividend payouts offer zero protection if the underlying capital base, your book value, is taking heavy hits from market volatility.
Section 6. The verdict on ARMOUR. So where does this leave us with ARMOUR Residential REIT today? We really have to weigh the optimism coming from the company's management against the stark risks identified by analysts.
On the bullish side, management is highly constructive right now. On their Q1 earnings call, they pointed out that if option-adjusted spreads, or OAS, tighten by just 10 basis points, that alone adds 3 to 5% in total return directly through book value appreciation. That could easily push total returns right up into the 19 to 20% range. If the macro environment cooperates, the upside is clearly there. But the bearish case is just as compelling. In fact, it led firms like Dividend to slap a straight-up sell rating on the stock. The critical risks here are structural. If agency MBS spreads widened against treasuries, book value depletes instantly. If there's a sudden shock in the repo market, it could force fire sales of assets at distressed prices. And fundamentally, analysts project distributable EPS to actually fall by about 11.5% annually through 2031 due to portfolio runoff and hedging costs. Which brings us to our final thought for today. When you're staring down a double-digit yield from an MREIT like ARMOUR, you really have to ask yourself, does the immediate income reward actually outweigh the structural risks of long-term capital erosion? Are you being paid enough to take on that heavy leverage and the brutal mark-to-market volatility? That is the real equation you have to solve for your own portfolio. Thanks for joining me on this explainer, and keep digging into those numbers.